Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this Analyze Out Loud video, I'm going to take a by-the-numbers look at Microsoft and try to illustrate why I believe the company is currently overvalued in spite of the awesome operating results that the company has achieved. So let's start just by looking at adjusted operating earnings here going back to June 1999. By the way, their fiscal year ends in June, which obviously just ended. So if you look at these results and consider that this company has a market cap of over $807 billion, this is really an extraordinary growth long term. They went through the recession of 2001 without really any great stress on their operating results. They had moderate stress. Earnings dropped about 9% during the Great Recession of 2008 and 9. Following that, they had some great earnings growth. They flatlined for several years. I want you to notice from 2011 really through 2016 there was not much in the way of growth. You can see the numbers down here, 3%, -5, -1, and 0. But then since that time, and again I'm looking at fiscal years here, since June of 2015, they've really strung together some nice growth. So let's go ahead and look at that period of time, if you will, and you can see that their earnings growth has been double digit. Once again, that's amazing for an $800 billion company with a AAA credit rating. So as I stated in the written portion of this video, I really like this company. I think it's a great company. But here's the rub. Well, before I do that, let's also look at their dividend record, because their dividend record is also great. This was a growth stock for many years. In 2003, they paid their first dividend. And if we go ahead and look at performance reports here, you'll see that they grew that dividend very nicely over this time frame. They did have a dividend cut apparently in 2006, according to this report, and you can see that right here. But otherwise, they had a great dividend record, and their payout ratio is somewhere in the neighborhood of 45 to 50% of their earnings in more recent years. So it really is a dividend-paying stock now. If I look at its historical dividend yield, you know, it's been yielding 2.5%. When the valuations got low, it got up to almost 3%. But I do want you to notice, as of June of this year, the dividend yield is 1.7%. You know, in other words, that's the current fiscal year end on June 30th. And it's right now about 1.6%. So this is relatively a low yield. That's the first indicator we have that the stock is really overvalued. So I'm going to go ahead and put dividends on the graph again. I'm going to put dividends and the dividends after they've been paid out, which is this light green. This is this area paid out to shareholders. But now here's the rub. Let's put price on the graph. But before I do that, I also want to calculate a normal PE ratio. Now this dark blue line is simply a calculation over whatever time frame I'm measuring. And I want you to notice that it indicates a very high normal PE of 23. The current PE of 27.2 blended is not really that much higher than that. But when I bring monthly closing stock prices into the equation, you can see that this normal PE calculation is heavily distorted by PE ratios that got very high back in the late 90s. It got up to over 70 times earnings at one point. And I do also want to point out that that led to some very poor performance. But I want to look at that a little closer as it relates to today. Today we have a 27.2 PE. Now I want to be clear. I want you to understand this orange line is a PE ratio of 15. So as you're looking at this graph and analyzing what you're looking at, when the price is above that orange line, it's a PE higher than 15. When it's below that orange line, it represents a PE that's lower than 15. Likewise with the blue line. The blue line on this iteration is 23 times earnings. But again, it includes these aberrant numbers. So I'm going to drop a couple of years off of this graph, and I want to show you something that I consider to be very fascinating here. Back in June, July of 2002, Microsoft was trading at a PE ratio very close to what we currently see. I'm going to hit this button here. It's 27.8 on October 31st, 2000. What I want you to notice again, as I iterated already, the company's earnings performance over this time frame was very good. Their dividend record was very good. But I want you to notice, if I take that 27 PE ratio in 2002 and take it out 10 years to 2012, you would have actually lost a little bit of principal. Your $10,000 would have shrunk to $9,955. The dividends kind of bailed you out, where you ended up squeezing out an annualized rate of return of 1.6% per annum. And that's very, very poor performance by almost any standard you want to look at. But the reason for that is what's important. The stock was overvalued in spite of excellent operating results, and that led to a significant period of poor performance. Now let's look more recently here at what's been happening with Microsoft. As I pointed out, several times already, the recent earnings performance has been excellent. I also pointed out that the stock price has been awesome. The market has been valuing this stock. You can see the significantly increasing PE. Now, I also want you to notice that the normal PE over this time frame is 17, which to me is a little more reasonable. So now I've got a PE of 15 and a PE of 17 on this graph. Now, clearly, coming out of the Great Recession, the PE got into a range of averaging about 10. We see a PE of even single digits here, 9.5 in May of 2011, and it stayed that way for several years. And then we've had this wonderful recovery. If I measure performance from 2012 up to yesterday's close, this stock has averaged over 29% a year, and that's really awesome. You would have turned $10,000 into over $39,000. You would have received $2,881 in dividends, so you ended up with a 4-to-1 investment, and that's not reinvesting dividends. That's having the dividends paid out to you, averaging just over 29% a year. That's really extraordinary, but the point is, if these numbers are reflective of true intrinsic value, as I believe they are, then you're looking at an opportunity for this stock to have anywhere between a 35 and 40% drop in value, as I talked about in the written part. Now let's talk about forecasting a little bit. This is one of the most widely followed stocks in the market. You can see that there were 29 analysts forecasting $3.83. As I indicated in the article, they actually came in at $3.88. It hasn't been not yet reflected on the graph, but it will be here probably by sometime tomorrow. But the point is, even that number doesn't really change what's happening here. Now, 33 analysts are forecasting the company to grow earnings to $4.01 for next year, and they're expecting a 16% growth in 2020. If I look at the long-term trend line growth, there are actually 9 analysts who believe this company will average about 12%. So I'm going to go into the custom calculator. I'm going to combine the recent estimates with the long-term estimates, and these numbers really show that this stock has enormous potential to grow. But again, the valuation that we're paying to buy it. So even if I go to that 17 or 18 PE ratio, you're looking at very anemic long-term returns and the possibility for a significant market correction in this stock if there's any hint of bad news coming up in the next year or two. When I look at the analyst scorecard from the standpoint of reviewing how accurate analysts have been over the last 5 years, they've actually missed estimates significantly in 2013, 14, and 15. They kind of met estimates within a 10% margin of error, and they actually beat estimates for 2017. And again, it looks like, they obviously beat estimates for 2018, which aren't recorded yet. But when I look at the record of that, it's important to recognize that there have been some significant misses here. So Microsoft has a lot of moving parts, and it's not a real easy company to analyze. But nevertheless, these estimates and double-digit growth is awesome for a company this big. I just believe the stock is significantly overpriced, and I think this picture, if you're really analyzing what you're seeing here, you can see high valuations always led to poor performance, or historically led to poor performance over a long period of time. Then we had this period where nobody liked Microsoft, where the PEs got down to 9 and 10, and now the pendulum has swung the other way, where we're up here to these valuations that simply make no economic sense. I like this company a lot. I really don't like the valuation, and I think you ought to be real careful when you're looking at it. Now, real quickly, let's look at diluted or GAAP earnings, because I also talked about that in the written portion. Again, you see the same situation. You see price trading significantly above what GAAP would indicate that it would be worth. Let's also look at EBITDA multiples here. This company normally trades at something around a 13 EBITDA. It's currently trading at an 18 EBITDA, so even based on EBITDA, it's overvalued. And once again, we see what happens when the stock traded at high EBITDAs historically. So no matter how you measure this stock, in my view, it's really an overvalued situation. From a dividend coverage perspective, looking at free cash flow, the company's really covering their dividend very nicely. Free cash flow, I haven't seen the numbers yet, but expected to, I think the fourth quarter was slightly down, but the company generates great free cash flow. Operating cash flow, which is another way to look at dividend coverage and even sometimes value a dividend growth stock. This stock has traded at a high normal multiple, about 13 times operating cash flow. It's currently at 18 times operating cash flow. The dividend is extremely well covered, and the valuation doesn't look quite as extreme. but nevertheless, the stock, in my view, is not a great buy today. If I was a holder of the stock long run, I would be looking at maybe taking some of the money off the table. If I was really interested in becoming a shareholder of this company, I might wait and look for a possible market correction. Anyway, this has been Chuck Carnevale saying thanks for watching.